Listen to me very carefully, and I don't say that lightly, because what I'm about to tell you is not polite, it's not comfortable, and it's definitely not what your bank wants you to hear. But it is the truth. And once you see it, you can't unsee it. I'm Kevin O'Leary. I've built companies, sold companies, invested in hundreds of businesses, and yes, I've made a lot of money. I've also lost money. Painfully. Publicly. And that's exactly why you should be paying attention right now. Because I didn't learn these lessons from textbooks or weekend seminars. I learned them by getting punched in the face by reality and standing back up. Let me be very clear about something. 7 or 8% a year is not financial freedom. It's survival. It's treading water while inflation quietly eats your future like termites in a wooden house. Your advisor smiles, pats you on the back, tells you to relax, and meanwhile your money is working harder for them than it is for you. Funny how that works. I didn't get where I am by being relaxed. I didn't win by being average. I won by understanding how money actually works when the cameras are off and the brochures are put away. I built businesses. I concentrated my bets. I took calculated risks when other people were too busy diversifying themselves into mediocrity. And here's the part most people don't want to hear. 30% annual returns are possible. Not magic. Not luck. Possible. But they are not for everyone. They demand discipline, focus, and the willingness to do what most people are too scared or too lazy to do. Over the next 20 minutes, I'm going to show you exactly why that number is real, how it's achieved, and why most people will never get anywhere near it. If that makes you uncomfortable, good. That means you're listening. Let me challenge something you've been told your entire adult life. That warm, comforting idea that if you just put your money into an index fund, earn 7 or 8% a year and patiently wait, everything will magically work out. That story sounds nice. It also sounds like a bedtime story, and bedtime stories are designed to help you sleep, not to make you rich. 7 or 8% doesn't build wealth. It preserves the illusion of safety. It helps you survive. It helps you feel responsible, but it does not help you break free. And there is a big difference between staying afloat and actually getting somewhere. Treading water feels fine, until you realize the shore is drifting farther away every year. Here's the part no one likes to say out loud. The financial system is not designed to make you wealthy quickly. It's designed to keep you predictable, calm, compliant. Put your money here, don't ask too many questions. Check back in 30 years. By then, inflation has taken a quiet bite out of everything you thought you owned. Not a dramatic bite. A polite one. The kind you don't notice until half the cake is gone. People confuse not losing money with building assets. Those are not the same game. Holding money is defensive. Building assets is offensive. One protects yesterday, the other attacks tomorrow. Most people are playing defense their entire lives and wondering why they never score. And time is not your friend here. Time is expensive. Every year you accept mediocre returns, you're not just losing money, you're losing opportunity. You're older. Markets change. Energy changes. Your tolerance for risk changes. The clock does not stop because your portfolio is comfortable. I see it all the time. Smart people, hard-working people, people who did everything they were told, and at 55 or 60 they suddenly realize the math doesn't work. They didn't fail because they were irresponsible. They failed because they followed a system built for averages, not outcomes. Index funds have a place. Safety has a place. But if your goal is freedom, speed matters. Growth matters. And pretending that 7% will save you is like bringing an umbrella to a hurricane. It makes you feel prepared right up until the moment reality shows up. This is not about being reckless. It's about being honest. And the honest truth is this: if you want extraordinary results, you cannot rely on ordinary strategies. And the sooner you accept that, the more time you give yourself to actually change the outcome. Now let me reset your expectations, because this is where people either lean in or quietly look for the exit. 30% a year is possible. Not in theory, not in fantasy land. Possible. But before your imagination runs wild, let me kill a few myths right now. 30% is not luck. It's not catching the perfect wave. It's not waking up one morning and discovering you're a genius because a meme coin went vertical while you were asleep. If that's what you're hoping for, you're in the wrong room. That's not investing. That's a lottery ticket with better graphics. 30% has a price. And the currency is discomfort. It requires discipline. Real discipline. The kind where you don't panic when everyone else is screaming. The kind where you don't chase shiny objects because your neighbor made money last week. It requires thinking like an owner, not a spectator. Most people want results without responsibility. That's adorable. It's also why they stay average. You have to be proactive. You don't wait for permission. You don't wait for consensus. You do the work before the opportunity becomes obvious, not after it's on the front page. And yes, that means pressure. It means stress. It means nights where you're questioning your decisions while other people are sleeping peacefully with their safe portfolios. Safety is very comfortable. It's also very slow. Here's the uncomfortable truth. Not everyone deserves 30%. Not because they're not smart, but because they're not willing to pay the price. They want guarantees. They want reassurance. They want someone to hold their hand and promise everything will be fine. Markets don't make promises. They make demands. I've earned those returns by making hard decisions when it wasn't popular, by concentrating when others diluted, and by accepting responsibility when things went wrong, instead of blaming the market, the government, or Mercury being in retrograde. Pressure is the admission fee. If you can't handle it, that's fine. But don't pretend you want elite outcomes while insisting on beginner-level comfort. So let me be very clear, and I won't sugarcoat this. If your top priority is safety, if volatility terrifies you, if you want to feel calm more than you want to win, then this video is not for you. And that's not an insult. It's a filter. But if you're still here, if you're uncomfortable in a good way, then you're exactly where you should be. Because extraordinary returns only come after ordinary beliefs are left behind. Now, this is where people love to misunderstand me, so listen closely. When I say concentration beats diversification, half the internet hears, "Go all in, close your eyes, and pray." That's not what I'm saying. That's what gamblers do. And gamblers eventually donate their money to smarter people. Blind diversification is comfort disguised as intelligence. It's spreading your money so thin that nothing can actually move the needle. It feels responsible. It sounds mature. And it almost guarantees you'll never achieve anything extraordinary. You're not reducing risk, you're diluting conviction. There's a difference. Concentration, when done properly, is not recklessness. It's precision. It's knowing exactly what you own, why you own it, and what would make you wrong. Most people don't do that work. They buy a little of everything, understand none of it, and call that being safe. That's not safety. That's ignorance with good marketing. Let me be honest about my own story, because people love the highlight reel. Yes, I concentrated early. Yes, I put most of what I had into building businesses. And yes, some of them paid off spectacularly. But there were moments where it almost blew up in my face. I missed sleep. I missed vacations. I missed a lot of dinners. There were days when one bad decision could have wiped me out. That's the part nobody puts on a motivational poster. Concentration forces you to grow up fast. When your capital is focused, you pay attention. You learn the numbers. You understand the risks. You don't outsource thinking to an advisor who barely remembers your name. You become an owner, not a tourist. Here's the formula, and it's not complicated, just uncomfortable. First, you understand deeply, not headlines, not opinions, the actual business, the cash flow, the downside. Then, you place a meaningful bet, not a symbolic one, a bet that matters. And finally, you manage risk like your life depends on it, because financially it does. You plan exits. You define failure in advance. You don't improvise under pressure. Diversification is what you do when you want to protect wealth. Concentration is what you do when you're trying to build it. Mixing those two ideas without understanding the context is how people get confused and broke at the same time. And let me add one more thing, because this matters. Concentration doesn't mean stubbornness. When I'm wrong, I'm out. Quickly. Ego is expensive. Hope is even worse. The moment the facts change, the strategy changes. That's discipline. That's professionalism. So no, this is not about being reckless. It's about being intentional, about choosing fewer things, understanding them better, and taking responsibility for the outcome. That's not comfortable. But comfort has never created real wealth. Precision has. Now we get to the core of it. This is where the theory stops and the structure begins. Over the years, I've learned that consistent high-level returns don't come from chasing everything. They come from building around a few pillars that actually work together. Not perfectly, not painlessly, but effectively. Let's start with private equity, because this is where people's eyes light up and their common sense tends to leave the room. Private equity is not easy money. It's not liquid. It's not forgiving. When you put capital into a private deal, you're usually locking it up for years. You don't get a daily price quote. You don't get to panic sell on a Tuesday morning. And yes, some of those deals will fail completely. That's reality. But when private equity works, it doesn't just work a little. It works in multiples. This is where growth actually lives. Early-stage companies solving real problems, scaling revenue, building value before the public markets ever get involved. The key is selectivity. I don't invest in ideas. I invest in people who've executed before businesses with clear paths to profitability and models that don't require miracles to survive. I want math on my side, not hope. And if you can't afford to have money tied up, if you need liquidity to sleep at night, this pillar isn't for you. That's not a judgment. It's a reality check. Now let's talk about real estate, because this is where discipline separates adults from amateurs. I'm not interested in flipping houses on television or praying for appreciation. I care about cash flow, predictable income, properties that pay me every single month, whether the headlines are good or bad. When real estate is done right, it gives you something most assets don't: income plus leverage. Leverage is powerful. It's also dangerous. Used intelligently, it amplifies returns. Used carelessly, it destroys people. I like leverage when the numbers still work under stress. What happens if occupancy drops? What happens if rates rise? What happens if the economy slows? If the deal collapses the moment conditions aren't perfect? It's not a deal. It's a gamble. I've seen too many people confuse real estate investing with real estate speculation. They buy because prices are going up, not because cash flow makes sense. That works until it doesn't. Cash flow gives you time. Speculation gives you anxiety. I prefer time. And then there's the third pillar, the one most people avoid because it requires the most responsibility: operating businesses. This is where real wealth is built. When you own and operate a business, you control the outcome. You're not waiting for the market to like you. You make decisions, you allocate capital, you fix problems. The returns here aren't percentages, They're multiples, but they come with pressure. You need to know your numbers. Every day, margins costs customer acquisition cash burn. Passion is nice. It doesn't replace discipline. I've watched entrepreneurs fall in love with their vision and ignore the math until the math shuts them down. A business is not a hobby, it's a machine. And if you don't respect that, it will break you. Here's where it all comes together. I don't bet everything on one pillar. I concentrate within each, but I allocate across all three. Private equity gives me growth. Real estate gives me cash flow and stability. Operating businesses give me control and upside. That balance allows me to pursue aggressive returns without exposing myself to a single point of failure. And let me say this clearly, none of this is passive. Anyone promising you 30% with no effort is selling you entertainment, not strategy. This requires involvement, learning, and constant adjustment. It requires saying no far more often than saying yes. And it requires understanding your own limits. Not everyone should do all three. But everyone who wants serious returns needs at least one pillar that actually moves the needle. This isn't glamorous. It's structured. It's boring in the right ways and stressful in the right moments. But over time, this framework compounds. Not just money, but experience, judgment, confidence. That's how real returns are built. Not by chasing headlines, not by copying your neighbor, and definitely not by hoping the market takes pity on you. You build systems, you accept responsibility, and you let discipline do the heavy lifting. Now, this is where most strategies fall apart, and it has nothing to do with intelligence. It has everything to do with behavior. You can have the perfect plan on paper and still lose if your psychology is weak. Markets don't reward brilliance. They punish emotional mistakes, and they do it ruthlessly. I've watched people do something almost comical. They buy when everyone feels good, when the headlines are glowing and confidence is high. And then they sell when fear shows up, when prices are down and opportunity is actually screaming at them. Buying high and selling low isn't a lack of knowledge. It's a lack of emotional control. Fear and greed are not flaws. They're default settings. The professionals learn how to override them. That's why discipline matters more than ideas. Discipline is boring. It doesn't get applause, but it keeps you alive. I don't make decisions on vibes. I make them on rules, real rules, written down. Not, I'll remember this later. If it's not written, it doesn't exist. I know exactly why I'm entering an investment, what would make me exit, and how much I'm willing to lose before I ever put $1 at risk. That way, when emotions spike, the plan doesn't change. Most people improvise under pressure. That's when they get slaughtered. Discipline is deciding in advance so you don't have to negotiate with yourself when the stress is highest. And yes, I break rules sometimes. But I break them consciously, knowing the consequences. That's very different from panicking and calling it flexibility. Now, let's talk about something everyone avoids at dinner parties: taxes. You can make phenomenal returns and still end up mediocre if you ignore this part. Keeping money is just as important as making it, sometimes more. Every dollar you lose unnecessarily to taxes is a dollar that never compounds again. It's gone. Forever. I structure everything legally, intelligently, and aggressively. I use depreciation. I use corporate structures. I hold assets long enough to benefit from favorable treatment. And I pay very good professionals to make sure I'm doing it right. People love to cheap out on advice and then act shocked when mistakes cost them 6 or 7 figures. That's not frugality. That's stupidity. Which brings me to the last piece, your team. No one builds real wealth alone. Anyone telling you otherwise is selling a fantasy. I don't try to be the smartest person in every room. I hire them. Accountants, lawyers, advisors, people who see risks I don't see and mistakes before I make them. That's not weakness. That's leverage. The irony is this: the moment you stop trying to do everything yourself is usually the moment your results accelerate. Because now you're operating as a system, not a solo act. This is what separates grown-up investing from amateur hour. Psychology under control, discipline locked in, taxes optimized, a team you trust. It's not exciting, it's not flashy, but it's durable. Anyone can get lucky once. Systems are what make success repeatable, and repeatability is the real definition of winning. Let's bring this home, because none of this matters if it stays theoretical. You've heard the formula: concentration with intent, not chaos, growth through private equity, cash flow and leverage through real estate, control and upside through operating businesses, wrapped in discipline, protected by structure, and executed with a system instead of emotion. That's how 30% becomes real. Not easy. Real. But here's the brutal truth, and this is where most people quietly disappear. Knowing this and doing this are two completely different lives. Knowledge feels productive. Action feels uncomfortable. One lets you nod along. The other forces you to change habits, conversations, and sometimes the people you listen to. Most people will walk away from this feeling inspired for about 20 minutes. Then they'll go right back to what feels safe. Same accounts, same excuses, same results. They'll tell themselves they'll start someday, which is just a very polite way of saying never. So here's the challenge. Not to me, to yourself. Are you actually going to do something differently? Are you going to learn deeper, focus harder, take responsibility when it gets uncomfortable? Or are you going to treat this like entertainment and move on to the next video? Because markets don't reward intention. They reward execution. They don't care how smart you are, how motivated you feel, or how many times you've watched content like this. They care about what you actually do. So decide. Be the person who acts, or be the person who understands perfectly and stays exactly where they are. One of those choices compounds. The other one just sounds good.